Let's now turn our attention to tax reform and planning. And to do that, I'm going to introduce Chris Finefrock in his role as Senior Vice President of Financial Planning and Investments. Chris and his team have already given extensive thought and analysis to what we might see in the way of planning scenarios after the election. I can assure you that as soon as the elections are over, Chris and his team will be the first to put out there a turnkey tool system and plans that you can take to your clients. Please join me in welcoming Chris Finefrock.
Today, what we're going to talk about is the other macro trend that we can't really control, but we can evolve human behaviors around, which is taxes, right? We can change spending, we can change savings, timing, risk profiles, those types of things in order to handle the tax environment. So what we're going to go through as soon as I get my slide deck up here is we're going to talk through the potential of the blue wave happening, where they take the presidency, they take the House, and they take the Senate. And if that happens, they've promised us this new blue wave. Let's see, there we go, perfect, thank you so much. They promised that they will have this tax reform, okay? So I wanna take 10, 15 minutes to go through the high level, like what does that mean in the different areas of corporate taxation, income taxation, capital gains, payroll, all of those things, but then to get down into the weeds a little bit about, well, what can we do about it with our planning, okay? A lot of the planning strategies, regardless of how the election turns out, are still good. It's just, they're going to be even better if this is actually the tax policy that's adopted. So let's go through that tax policy. So the new levies on income and payroll taxes is estimated to be above $3 trillion, okay? It's actually closer to $4 trillion. We'll get exactly through what each of those facets are, okay? I wanna go through each one of them individually. First, I'm gonna talk about income taxes. So the income taxes are going to go up slightly from a 37% highest marginal tax bracket to 39.6. Everybody's talking about the repeal of the SALT deduction. However, there's going to be this new limit on itemized deductions where you're only going to get a cap of 28% versus your marginal tax bracket on some of your deductions if you're a higher income earner. Plus, we're going to get the P's limitation. So are you going to get to deduct everything again? Yes. Are you going to get as much benefit? No. So we're going to talk about how that kind of does the same thing as eliminating the SALT deduction in just a little bit. One of the biggest changes is this donut hole payroll taxes. So currently, we all have to pay payroll taxes on the first $137,000 of income. If you're self-employed, you get to pay the whole 12.4. If you're a W-2 employee, you pay half of it, your employer pays half of it, and then you're not taxed on the excess. Okay, the proposal is that there will be a donut hole where you still don't have to pay it until you go over 400,000, and then for every dollar above 400,000 that you have an income, you will begin paying this payroll tax again at 12.4%. So pretty big, steep increase. We're not having a giant ordinary income increase, but on the payroll tax side, we are. Couple that with a capital gains overhaul that kind of makes you fall out of your seat a little bit. So the idea is that we're going to move from the capital gains rate of a 20% up to ordinary income when capital gains get above $1 million. So think about this for some of your businesses that get sold and things like that. We deal with these liquidation events all the time. Pretty big increase, right? A 66%. In addition to that, the Medicare surtax still applies, so you're well over 40% on the capital gains if that happens to your client, okay? Couple this with some of the estate and inheritance tax proposals, it creates the biggest inheritance tax ever, okay? So the way it works is not only does capital gains go to 39.6% once you're above $1 million, but couple that with there's no step to basis when there's a passing. Okay, so think about grandma's coin collection that was purchased in 1950s, right? And you're going back and you have to figure out the basis in that in order to sell it and pay taxes on it when you inherit it. There's an administrative issue with this step to basis, as well as going to have some big impacts for more of the masses instead of just for the ultra high net worth, which we'll talk about just in a little bit. addition, they've promised time and time again, I'm going to repeal the Tax Cuts and Jobs Act, which will take the state tax exemption from 11.58 to 5.79. There's also been other communications that have come out that Biden might adopt the Sanders policy, which is remove that all the way down to 3.5 million versus the 5.79. Continue the top estate tax at 40% though, but it's 40% estate tax combined with a 40% plus capital gains tax. They stack. And we'll go through exactly what that means for ultra high net worth and your average mass affluent family. Some other tax changes is increase the corporate tax rate from 21% to 28%. Might not seem like a big deal, but in aggregate, this is the biggest change. This is the one that's going to create the most revenue for the government, okay? Addition to that, they're going to have this corporate minimum tax rate of 15% if you show profits over 100 million. So you're not going to see the reports about Amazon paying $4 in taxes or whatever it was. There's going to be this alternative minimum tax for corporations as well. Right now, there's a pretty complicated, are you a service company or are you not a service company in order to get this QBI deduction based on incomes, and there's phase outs and there's all this stuff. They're going to simplify this that basically makes it not worthwhile for anybody over 400,000. So we need to think about how can we get taxable income or AGI below 400,000 for some of our business owners so that they can still take this QBI deduction under 199A. And then in order to incentivize companies not to move overseas where the corporate tax rates in the EU, for example, is 21.8 and where we'll be taxed at 28, they're going to double the foreign income tax. So hopefully that will keep companies in the US. And they've sprinkled in some nice tax credits here. A refundable tax credit, similar to like we had after the financial crisis for first-time home buyers of $15,000. I'm not sure why, besides maybe in the inner cities, it seems like real estate's doing okay right now. I don't really know why we need more incentive to boost up real estate prices, but $15,000 refundable tax credit, which means even if you have zero tax liability, you'll still get a $15,000 check from the government. So that's nice if you're not a homeowner right now. Child care informal credits of $8,000 and $5,000. Disabilities, and then also renters credit so that you're getting some of the benefits of renting like you would if you had home ownership. So in aggregate, this is how it all shakes out. As I said, the raise in corporate taxes is the biggest revenue generator, but look at all the other ones that impact our individual clients as well. So what I want to do is now I want to start talking about, well, what do we do about this now that we know? We got to start planning today because we're not going to have a lot of time if they're going to, if they do win the elections and then they bring this about in 2021, we don't have a lot of time to do planning in advance, and especially in this estate tax area. It's why Larry and the team put forth the Blue Wave presentation in February, I think, of this year, to try to give us enough time to talk about clients because you have to start lining up trusts to have that lifeboat in case the Blue Wave takes over. So let's talk about a really simple example of why it's so important to do this planning beforehand. So this is for our affluent clients. Let's just take, for example, that we have a $20 million estate with a $5 million basis in all that assets. So that can be a business, that can be a farmer, that can be a really successful investment person, right? $5 million in basis, $20 million of fair market value. First, let's talk about what that would look like today. Today, we have a gross estate of $20 million. There's no capital gains at death, so we have a step to basis, which means no capital gains. The taxable estate's $20 million. The estate tax exemption, if it's a married couple, is 23.16, so you owe no taxes. The net to heirs is $20 million. Pretty clean, not a lot of planning, not a lot of opportunity, right? Let's go to the two other scenarios under the Blue Wave. Okay, first off, let's go to the Biden policy with just the repeal of the Tax Cuts and Jobs Act. $20 million gross estate. Everything over $1 million in capital gains gets taxed at 39.6%, 5.9 million. So we get a taxable estate of 14 million. Our estate tax exemption is cut in half, so now we only have 11 million there. So we have to pay another 992,000 in estate taxes over and above the capital gains tax, so we net out at 13 million. Okay, a 35% reduction in that estate value. The second proposal is basically the same thing, only we no longer have an $11 million estate tax exemption. Now we have a $7 million. This is the Sanders proposal, okay? So we back out the capital gains, we back out the increased inheritance tax, and now we're getting down to 11.2 million. So a 44% decrease that can happen 1 year or 1 day, December 31st to January 1st, in an estate that is 20 million. Pretty big impact, right? Well, let's reduce the estate by 10 times and not look at the affluent client. Let's look at the mass affluent client that is in almost every one of our books, where we have a $2 million estate, and this is, you have a house, you have an investment portfolio, you have a couple of collectibles, all of those things, right, that total up to $2 million of net worth, and you pass away. Well, you're still under the estate tax exemption, but this elimination of step to basis is a big deal. The gross estate is at $2 million. So let's look today. Right now, you get the step to basis, so your family gets $2 million. Under this proposal, the $2 million, we'll have to pay capital gains on all that increase over basis. It hasn't been said whether that's over time, whether your family just gets to continue on, or it's an immediate tax. That's what everybody's thinking that it will be, is that you're going to have to liquidate in order to pay the capital gains tax and experience it at death. So not only think about the fire sale of liquidating some of these illiquid assets, like the house, like the collectibles, those types of things, in order to pay capital gains, and it doesn't just impact the $20 million household, it impacts the $2 million household as well. So that's on the estate tax side, and you can see that it's not just estate tax, it's this capital gains change that we're having that's for the generation transfer. So now I want to shift our attention to the income planning side of the equation, okay? We've got a lot of material on the estate tax side that we can direct you to. Reach out to us and we can share it with you as far as what strategies can you do throughout the rest of the year in order to get ready for this, because you're not going to have a lot of time in order to make these changes depending on how the election goes. So shifting to income tax planning. Let's look at tax optimized solutions. So we talked about capital gains going up, talked about itemized deductions going down, all of these things. So what can we do that are going to be more important than ever? These are good strategies today, like I said, even regardless of how the election goes, you can still look at these things and they still make sense in certain situations, okay? So we're going to see the rise of the deferred compensation, okay? And I'm going to show kind of what I think versus what the most prevalent deferred compensation plans look like today. The defined benefit and cash balance plans, the profit sharing and 401k plans, and then you have these accumulation insurance and accumulation annuities. We're seeing some of the insurance companies really innovate in these spaces that are going to basically try to rival just our SMA accounts as far as how they distribute these types of accumulation products that are very efficient for accumulation. So let's start off with retirement plans. And let's start off with something that I feel like is the biggest thing for these moderate to mid-sized partners or business owners that are really teetering right around that $400,000 of adjusted gross income. So again today, I took this from one of our partners that we work with closely, Trinity Pensions, who's a TPA that's been very helpful to us. Today we have this confusing formula on whether or not you get this QBI deduction and then when it's phased out versus when you get it. Biden's proposal is basically if you're over $400,000, you don't get a QBI deduction, okay? So the question becomes, how do we try to maneuver things on your tax return in order to get below that $400,000 trigger? Well, let's look at this scenario right here. So how do we get taxable income under what was currently $326,000? It's going to be $400,000 under the Biden proposal. Let's say we have an individual with a $400,000 income. We don't have any retirement plan contributions, so they don't get any 199A deduction, right? You're completely phased out because you're over that $400,000, so they got a net taxable income of $250,000. So with the retirement plan, we can say $450,000, $150,000 would go into the retirement plan contribution, $60,000, you get the full QBI deduction, so your net taxable income is $240,000, almost half. How many clients would love to pay half taxes, right? So the question in this is, how do we get $150,000 into a retirement plan? Well, let's go to the contribution limit. So Traditionally, what we say is, oh, you should have this SEP, you should have this solo K, you should have something that you can put, your $26,000 in, your elective deferrals plus the catch-up if you're 50 and older. Or let's add a profit-sharing component to get up to $63,000. Something that we're not seeing a ton of, which takes a little bit more work, you gotta get a TPA in there, you gotta do some actuarial things, is the cash balance plan. And the cash balance plan, you can get up to $349,000, but it's all based on the income, the wages and ages of the individuals at the company, okay? So the ideal client inside of a cash balance plan is looking to have $50,000 or more in tax deductions, something that some of the firms that make the most sense, CPAs, law firms, medical groups, professional firms, solo owners, family-owned businesses, closely held businesses, financial professionals, those types of individuals make great sense for cash balance plans. Again, contributions are based on ages of wages. The $349,000 is kind of like the ideal scenario where you've got an older, high-income business owner that can put away more because it's all based on actuarial assumptions between how much you can put in between now and retirement age, okay? So that's the ideal cash balance plan owner down there. And obviously, if you have a owner-only practice or if you have a lot of younger, lower income individuals working at the firm, it's going to make a ton of sense in that scenario as well. Something with the Secure Act that changed a little bit about how cash balance plans can be operated has given rise to some of these other cash balance designs that really make it efficient for younger clients as well. It takes a little bit longer for these plans to be fully optimized, about 7 years, and then you get to freeze some of the plan participants and things like that, and you can really leverage up how much they're able to contribute. And so again, don't just look at cash balance plans for older clients that have young employees that make almost no money. Like, call us, let's talk about them, because it's made sense in a lot of cases for the younger clients that have good cash flow as well. The other one is cash balance plans, oh, they're too expensive because I have too many employees, I need to include too many people in the design. That's not necessarily true. This is probably the area that I've learned the most in the last 12 months is around ERISA and some of the maneuvering you can do within ERISA. So Carve Out Plans basically allow, when you have a profit sharing 401k plan and you add on the cash balance plan, you can only need to include 40% of the employees that you have inside of the carve out, and you can base that on job characteristics and things like that, and you don't even need to put a ton of money in for all the people that are participating in the plans. Maybe it's just a $1,000 cash balance contribution, but the owner and anybody else that's classified in that executive suite might be able to put away $60,000, $70,000. So it's all dependent on the specifics of the individual business, but partnering with an experienced TPA is the most important piece. They're gonna know all of the different ins and outs of this. So if you don't have a local TPA that you work with, we've partnered with a couple locally and nationally in order to do this type of work that you don't have to kind of go it on your own. So we've been introduced by some of our top qualified plan offices to these TPAs, and they're doing this type of planning. So let's move on to corporations and executive retention. So the reason that non-qualified plans, if the cash balance and the profit sharing and all of that doesn't reduce income enough, the reasons the non-qualified plans are gonna become more attractive is because taxable investments are gonna become way, way less attractive. We just talked about capital gains increase. In addition to that, just making more money in quarterly bonuses and things isn't gonna look as good because we're gonna not get as much deductions or capital gains phase outs as well as the marginal tax bracket limitation where you're gonna be paying tax at 39.6%, but you're only gonna get a deduction of 28%. We're gonna look at that, as well as the higher marginal tax brackets going up to 39.6. So where I also feel like this is gonna be a big deal is with the payroll tax, okay? So you have this donut hole, remember, where the first $137,000 you're gonna pay payroll tax, then you won't pay anything until $400,000. Over $400,000 you're gonna have to pay that payroll tax, okay? If you have employer-funded contributions, okay, so this isn't a voluntary deferred compensation plan, this is more of a SERP plan, okay, where the employer is funding and the employee has substantial risk of forfeiture, rabbi trust, the company goes out of business, you might not get this funds, right? The payroll tax is not owed until that is vested, so there's no substantial risk of forfeiture anymore, right? So if you can restructure some of the deferred compensation plans, or you can tee this up that, hey, you won't have to pay this extra 12.4% if we do this more as a SERP rather than a voluntary deferred compensation plan, you won't have to pay this 12.4%. And if you don't vest in those contributions until your income is lower than $400,000, you'll never have to pay the 12.4%. That sounds like a pretty good deal, right? So employer-funded SERP plans where you're going to take some of the income and you're going to put them more into that type of structure versus a voluntary plan. Again, 90% of the Fortune 1000 companies have these type of non-qualified plans. And like I said, the most common strategy today is a voluntary deferred compensation plan. The one that I feel like will grow under this tax policy, again, is this bottom one, the supplemental executive retirement plans, or SERPs, if structured properly where it vests after the income is dropped, okay? So now let's move more on to the individuals and retirees. So that kind of covered like the corporate services market, the 401k, the cash balance, the defined contribution. Then we talked about some of the COLI type of designs, and now we're gonna talk about the individual retirees. So what are a lot of clients asking us today? I always try to go back to why is this a big deal, and what are people, you know, they're reading the Wall Street Journal, they might see something on the news about this, and they're asking, how does this change my taxable account? Does a Roth conversion make sense for me since I heard taxes are going up? How do I get the highest net income from what investment should I be investing in to get the highest net income in retirement? Or capital gains is going to change, so how do I get the most money to the next generation? The other thing that we started talking about with the Secure Act, which seems like so long ago, and it was just January, was how do I optimize my next nest egg for optimization for multiple generations? And we came up with this bracket topping type of strategy where we take strategic lifetime distributions just from IRAs, because the whole lifetime stretch of IRAs went away. Now, if this goes into place, it's also going to apply to taxable accounts. How do we take funds out of capital gains during lifetime to optimize those lower capital gains brackets? Because if we go over $1 million, we know that we're going to be taxed at 40% versus 20%. And the last thing is the donor advised fund. How do I give maximally and most efficiently? And this is the one that has probably the most implication, other than some of the estate planning things, today, because I'm going to go through why it's such a big deal that you're not going to get as much benefit from the charitable contributions after these tax changes would go into effect. So let's talk about asset positioning. It was on that Vanguard study. I think it said up to 75 basis points of value can be added through asset positioning. So let's talk about the Tax Optimization Illustrator a little bit. So this is a module that we rolled out probably about 5 years ago. And all it is a giant math equation. And it's basically asking the client, tax rates today and in the future, what do you think is going to happen? Do you think they're going to stay the same? You think they're going to go up? You want to be conservative? You want to be aggressive? Okay. Same thing about capital market assumptions, you know, stocks and bonds. How much do you need to contribute to an annual retirement savings vehicle? What is your existing balances? What is your existing basis? What do you think about portfolio turnover and underlying expenses? Now, I know clients are going to not answer all of those questions. You give us those answers and we run the output, okay? It's just a math equation. And what it does is it compares tax-deferred, tax-favored, and taxable vehicles to one another. So tax-deferred are your things like your after-tax IRAs, your 401ks, and non-qualified annuity. Tax-favored is Roth IRAs, accumulation insurance, municipal bonds, and then your taxable portfolios are obviously just your non-qualified assets and trust assets, okay? So let's look at how the tax optimization actually works and how we're kind of positioning this, especially for individuals with investment portfolios today that is now going to have to think about some of the capital gains changes that could be coming under the Biden administration. So here I'm going to go through a quick example of, let's say we have someone with a $3 million taxable portfolio and $2 million of basis, okay? Not bad as it's $1 million of gain, which we know will keep us in those lower tax brackets, 20%, right? It's only if we go over $1 million in capital gains that we're gonna have to start paying 39.6. So they're asking the question of, what do we do about our dividend reinvestment strategy? Currently, what do we all do? Oh, we're gonna reinvest the dividends, we're gonna put it back into the strategy, and it's gonna grow over time, right? What if we took a different approach of saying, well, maybe we don't want to sell out and experience this full $1 million of gain, but should we be, if we're expecting a 2% dividend, should we be taking that $60,000 a year and reinvesting it inside of the taxable portfolio and just making the problem worse? More capital gains, more growth, more of a problem with no step to basis, right? What if we took this and said, well, how do we optimize this and say, should we be inside of a tax favored or tax deferred vehicle so we're not going to proliferate a problem? So our assumptions here is a 7% rate of return on equity, 5% of that is capital appreciation, 2% dividend growth, assume 1% of expenses, and let's assume this is over a 40-year timeline. What the Tax Optimization Illustrator does is it aims to show the net amount of the investment at the end of the time period. Traditionally, how it's been run is it's been for retirement income. So I'm going to accumulate assets for 20 years and I'm going to distribute assets for 30 years, okay? But it doesn't mean it has to be just for, the net income doesn't have to be just for retirement income. It can be for net to heirs as well, okay? So I'm going to accumulate assets for 39 years, and then when I pass away, 1 year is going to go to the next generation. It's the same concept, it's just with a shorter distribution period, right? So here's how it looks under current law. The taxable portfolio will yield, because this is looking at expenses, it's looking at the turnover, it's looking at all of those things within an equity portfolio. With the 37% tax rate and the 23.8% capital gains rate, this is the net income to heirs based on the different vehicles that we could use today. So if we just took the $60,000 a year and reinvested those dividends into a taxable, tax deferred, or tax favored strategy, which one would yield the most net income? In this case, the taxable is in the middle, the tax deferred is the lowest, that's like a non-qualified accumulation annuity, and the best case is a tax favored vehicle because with the step to basis and the ordinary income. So already today, like I said, even if the election doesn't go into a blue wave, the tax favored already wins. So this would be a good solution if whichever administration takes over. Now what I want to do is I want to show the exact same scenario under the Biden proposal. So now we have an increase in ordinary incomes, and we have the capital gains, and we have no step to basis, okay, on the distribution side. So now what we see is the taxable portfolio is the worst solution. It's not the middle, it's the worst. So a tax deferred vehicle, going back to the early 2000s when annuities were really built for tax deferral, not for income, not for death benefit, but for tax deferral, this is the environment where the annuity could make sense again, okay? But far and away, that tax favored bucket, whether that's getting money into Roth type of vehicles or accumulation insurance, it becomes the most tax efficient way by far based on these new tax proposals, okay? So hopefully that makes sense. Either way, the tax favored wins, tax deferred becomes a lot more sexy if these tax changes do take place. Next thing I want to talk about is strategic lifetime distributions. We call this bracket topping a lot of time, which is basically all we're doing is taking a bracket, lower marginal tax brackets, and we're filling them up to get the lowest taxes before we hit some tier that will cause higher taxation. So here we have the capital gains and Medicare surtaxes as we fit them into buckets. So for the first $80,000 of income, we don't pay any capital gains, no Medicare surtax. Then for the next $170,000 until we get up to $249,000, we pay 15%. At that point, the Medicare surtaxes kick in. Yes, Medicare surtax kicks in and we get to pay an additional 3.8%. In addition, within that bracket, we also have the elimination of some of the P's phase outs for our income, as well as the cap on our deductions at 28%. And then we go to 23.8 and then to 43.4%. That's just looking at capital gains. This is a more complicated thing to talk through with clients because it's a two-phase process, okay? Bracket topping discussions start with how do marginal tax brackets work? Most clients just think I'm in the 24% tax bracket or I'm in the 32% tax bracket. They don't think my effective tax rate is 18% or my effective tax rate is 12%. So we need to start with how do marginal tax brackets work, and then the next phase of that is the interactions between ordinary income and capital gains in order to figure out your total tax situation. So just like Caleb, I read Michael Kitces a lot, and I stole a couple of his his charts because I think they're the best that I've seen in order to articulate this very succinctly on how this works, okay? So here's the marginal tax brackets, and you can basically see how they tier up in the ordinary and then in the capital gains space, okay? And this chart, I feel like, is the best one of explaining how they stack on top of each other. So let's talk about gross income. You got gross income from W-2, self-employment, so on and so forth. That's in green. You have 60,000. From there, you get to take all of your deductions. So whether you itemize or take standard deduction, in this case, it's a standard deduction for a married couple, so you back that down, okay, by 24.4, and you arrive at your total taxable income for that individual, okay, 35.6. You can go over to the left-hand side and look at the blue columns and say, some of that is going to be in the 10%, the light blue at the bottom, some of it's going to be in the 12% tax bracket, and you're going to owe $3,800 in taxes for ordinary income purposes. At that point is when you stack on your capital gains taxation and come up with how much capital gains that you're going to owe. So in this situation, all the way up to 80,000, you will pay 0% capital gains, okay? And then over and above that, you'll start paying 15%. So the interaction between ordinary income and capital gains rates and how they stack on top of each other, I think this slide does the best job of simply explaining to clients how that works. Once we arrive at that, we can then start talking about bracket topping, okay? So where are the sweet spots for bracket topping? That's the most important part of this, right? So the sweet spots for bracket topping, I feel like, are these. You might have different opinions. You're entitled to them. I think these are very good benchmarks to talk about bracket topping. So if someone only needs $3,000 a month to live off of and they got a lot of capital gains, well, what you start talking about is, well, we should start experience capital gains all the way up to $78,000 because you don't pay any tax on them. You can sell out of things and not have any tax liability on capital gains if you stay below $78,750. I think that's last year's, it's $80,000 a day. The next tier really gets into the IRMA Medicare premium. So how many of your clients like to pay double for Medicare that everybody else does? Nobody, right? This is a really important one that I think gets glazed over a lot. Once you hit $174,000 of taxable income, that's where you start paying more and more for Medicare premiums, okay? So for a lot of your $100,000 a year, which is pretty much the average that we see for risk plans that we run, you can start looking at bracket topping and paying somewhere between somewhere around 15% of capital gains in order to maximize without increasing Medicare premiums. The next one is at $250,000, okay? $250,000 is when you go from 15% to 18.8% because of the Medicare surtax. So we want to try not to go above that 250 line. $400,000 is when the itemized deduction caps come in and you start getting phased out of some of the deductions that you can take. Almost at $500,000, the 20% capital gains begin, and then the one that we don't want to see take place at the beginning of the year is at $1 million when capital gains mirror ordinary income rates. So how do we model this? Well, luckily we have this strategy called Risk, Arc, and Estate Snapshot that are all cash flow models, right? And what we do is we layer this strategic lifetime distributions or bracket topping strategies over and above what the client needs to live off of. So you can always say, we're going to take care of you first, and then we're going to optimize your situation and spending strategy over and above that. So this is where we talk about strategic lifetime distributions, and you can do this during the accumulation phase, you can do this during the distribution phase, you can do this part of the wealth transfer planning that we do, okay? So that is the strategic lifetime distribution part of the presentation, and again, I implore you to try to look at your clients, figure out their tax situation, get their tax returns, and then start working with us in order to put together bracket topping strategies and looking for some of those solutions in order to take advantage of some of those lower tax brackets. The last thing I wanted to talk through is the charitable planning. Something that makes no sense to me is that tax rates are going to go up, but the deduction that we receive from charitable planning or charitable giving is going to go down and down substantially. So I want to look at how an example of the P's phase outs and the itemized deduction cap at 28% will impact an individual. Let's say this individual sold their business, had a big golden parachute payout, something like that, where they have over $1 million of income this year, and they want to make a charitable donation of 10% of that, so $100,000. Under current law today, you have your ordinary income, you back out your above line deductions, those are your 401k contributions and things like that to arrive at adjusted gross income, let's call it $900,000, okay? Below that, you get to take either your standard deduction or itemized deduction. This case, we're saying they have $40,000 of regular below the line deductions. Then you get to take your charitable deduction to get down to taxable income, okay? All of the results are basically based on one thing. What is your marginal tax bracket? 37%. There's no phase outs and deductions, and there's no itemized deduction limitations around that aren't tied to your tax bracket. So you get a full 37% benefit from giving this to charity, okay? Let's look at what happens when we introduce the 28% itemized deduction cap, the P's limitations on phasing out how much you can deduct, as well as the higher marginal tax brackets, okay? Everything else stayed the same, but we increased the tax bracket, the P's came in, and the itemized deduction. So now we're gonna give $100,000 to charity, but we're not gonna get to deduct the full $100,000 because every dollar we earn over $400,000 is phased out $1 for every $3. So it's gonna take our deduction down to $69,840. That's gonna be our below the line deduction for that. In addition, that $69,000, we can't take our full deduction of 39.6% from it. We can only maximize at 28%. So I'm getting less of a deduction and less benefit from that deduction. So what we're actually going to experience is instead of $37,000 in a tax savings, we're gonna get $19,000 for the exact same gift given one day apart, December 31st versus January 1st. Isn't that crazy? Everybody's talking about the SALT deduction coming back and it's gonna be a great thing, but when you look at things like this, it doesn't matter because you're not actually able to take advantage of some of these deductions the way that you normally would because of these other things that come into play. So a lot of uplifting information about taxes increasing, but a lot of opportunity, right? That's where we usually thrive and we can help our clients navigate these. So Caleb talked about U-squared a little bit, where we can help illustrate this and you don't have to do it all on your own. I was talking to someone yesterday about them trying to create a donor advised fund module themselves and things. I'm like, oh, we have that. You know, whenever you're gonna sit down and spend 4 hours on something, trying to create it yourself, at least give us a call to see if we got something. Because we've probably done it before, or at least in some fashion. We do 9,000 plans a year. None of them look identical. So I'm not saying we know it all, because we don't. I learn something new almost every day from some facet of planning, which keeps me really interested, right? But give us a call because we have ways of illustrating all of these things, whether you're trying to go through the tax and capital gains, whether you're trying to look at the impact of gifting, whether you want to learn more about qualified plans or non-qualified deferred compensation. We have resources like the Tax Optimization Asset Positioning tool. We have the Illustrating and Risk and ARC. We have the Donor Advised Fund module. We got Retirement Turnkey 338 if you have retirement plan opportunities but you don't specialize in that market. And then we have Deferred Compensation Turnkey processes like 5R that was rolled out earlier this year if you have opportunities for SERPs or discretionary or deferred compensation plans. And then the individuals on the team that will help support you in those ways if you're looking for a point person to start the conversation.